Randy, welcome to Product Growth Stories. I'm so happy to have you here and talk about your journey as a founder building iFlip. So welcome to the show. Why don't we start off with what is iFlip and why did you choose this particular problem to solve?
So iFlip is a really simple to use investment platform. We're powered by AI and machine learning. And what we do is we protect wealth while consistently outperforming the markets.
So does this differ from, say, a trading bot?
Yes, big difference. A trading bot, first of all, doesn't use AI. At least I've never found one that does today. They will eventually. They're not doing it yet. They're using simple mathematical algorithms, which can be good, but all mathematical algorithms, and any mathematician will tell you, they decay. And so if you turn on a mathematical-based algo and you put it into a computer to automate, let me give you a simple example. The easiest bot in the world, Apple. If it gets more than 10% above its 200-day moving average, buy it. And you can program that in, simple mathematical algorithm, and it will go on forever. Every time Apple gets 10% above that moving average, it'll buy it. That's a bot. Whether it's Forex, whether it's futures, wherever you see it.
These simple algorithms, right? I remember talking to a friend of mine that really went nuts into trading bots, and it was like they were very simple things like greedy algorithms. If you see this trend continuing, buy it. And it really, your execution times really mattered for that to make sense. And
that's what's available and promoted as AI in the world today. The big differentiator is this. For that algorithm to be considered AI, it would have to be able to change its own rules. So all the bots you see out there, that 10% above that moving average, if you want to change it, a human who has an opinion has to go in, type it in, change it, and it will go. In our particular case, all of our symbols on our platform that are in what we call smart folios, every one of them does have an algorithm, but the difference is that algorithm doesn't report to a human. It actually reports to the machine.
I see. So you can update the strategy based on like macro market trends that
we don't even update it. It's all machine learning. It's all no more human involvement. It's on its own. So in essence, the algorithm can change its own rules.
We just went super nerdy because I happen to know this tiny bit too. And I'm just wondering, like, how does this make sense for the average person that you would like to join your platform? They might not be a Forex nerd. How do you make sense of this for them?
It's real simple. We've put it on a point and click format. Literally, you can point, click. You pick what we call a smart folio. It's made up of a bucket of stocks and ETFs. No Forex either. It's all stocks, ETFs. And what it will do is, once you say, okay, I like that one called Big Tech, which is really just the Mag 7. It's those 7 stocks. You can see it's these 7 stocks. And if you like it, you just assign a dollar amount to it. Then the AI takes over and does all the execution for you. So you don't have to know a single nerdy thing. In fact, I'm not typically that person. I've just happened to learn enough about it to be able to have the conversation. And that's the differentiator. It's when it becomes fully automated and fully controlled by the AI, you can truly mitigate your losses. Let me give you an example of how this works. This year, the markets have been crazy. Everybody knows that. So I'm going to give you one simple example. The S&P 500, the SPY, it's the ETF that is the proxy for it. Algorithm said, get out early January. So it took all of our people out. But in the morning, every day, it reports not to a human, but to the machine learning, to the AI. If the AI agrees, it allows the algorithm to execute. It did that in January, stayed out all the way till April 9th. We missed the horror show. And then more importantly, the AI overrode the algorithm on April 9th and put it in the S&P and took advantage of that one day, that 10% single day gain, a trade of a century that it actually captured. And then within 2 days, the AI again agreed with the algorithm and got it out. Just about a week ago, they both agreed again, and now we're back in the S&P 500. And so the checks and balances are there to protect you. We say risk protection equals performance. So we want to mitigate risk.
Yes. This applies everywhere in life. If you remove the giant potholes, you're going to do a lot better in life. So how do you, obviously, I'm sure there's all kinds of disclaimers we'd have to say if we're talking about what you can expect in the future from the performance, but how is it performed versus other options like bots or just buy and hold and not pull out of the market? What's the guy? Bogglehead, this method, how is it performed versus those different strategies?
Better. And then when I say better, so I always qualify that. Better meaning we intend, never guarantee, can't guarantee performances. Also, we are not regulated. So because we're a software company that enables you yourself, even though it's automated, you're choosing what to automate. So it's under the control of the people. So how do we compare it in general? One, we can't decay because the AI is always updating the algorithms. So it's in permanent growth mode all the time. And by design, we don't want people, not that it could never happen, but we want to do a couple of things. One, we want to beat the S&P 500 or worst case, match it. We want to do it with half the risk of owning it. So think of it like this. People, what do you mean half the risk? Everybody asks, how is the performance? That's the wrong question. If you only care about performance, buy lottery tickets. They have the best performance.
Risk-adjusted returns. That's what we're looking at.
And what does that actually mean? That means what risk did you take to get the return you got? Best example I can give. If you went to Vegas, everybody knows Vegas, and you go to, there's 2 blackjack tables. One blackjack table pays you $1 if you bet $1 and you win. This blackjack table pays you that same dollar, but you only have to bet 50 cents. Which table will you play on? The one that only risks 50 cents. So if you lose over here, you lose 50 cents. You lose over here, you lose $1. Correct. But if he found a blackjack table that would pay him 2 to 1 on his bet, he would then gamble because you can then win.
Man, this is a fascinating product. It actually is, in my opinion, I'm not an expert in the area, but it seems to me very unique because I've seen other trading bots and it's really different standard algorithms being applied. So that's fairly amazing. And I'm curious, how are you going out and finding new, would you call these traders, like new traders to join your platform?
Investors. We're not a trading platform. We're not thinkers. We're not interactive brokers. We're not trying to encourage people to be on their computer trading. We're more think Betterment, Wealthfront, Schwab, Fidelity, Vanguard, places where you would go sit down and spend a lot of time and money to have somebody manage it for you. We just start teaching you how to do it. Our vision is very clear. It's to empower. It's the key word. Empower everyone to preserve, protect, and grow their wealth. When we think about that, we're not a trading bot. So how do we get them? Well, the best way to get customers that you want that are sticky is word of mouth. Right now, word of mouth is our biggest asset. We're adding 10 customers a day on average and $100,000 onto the platform. We've got well over $63 million now on the platform and adding and growing every single day. We grew at 428% last year, and we haven't done any formal marketing. And so getting people to talk about you is number one, how we grow. I've got a track record as a speaker, and I know a lot of other speakers in the world. And just in general, when people find something really cool and good, they start talking about it. They will tell somebody about this after this podcast. You'll be like, all right, I saw this coolest thing. And people do that. We are in the middle of a Series A preferred funding round, at which point we will start a formal, large marketing campaign that will be going out on a global scale.
So if I understand like where the business is at, you're working towards a Series A, and everybody in SaaS knows that is more difficult than it used to be. And you have to have a very good growth story. And it sounds like you do per marketing dollar spent. So man, congratulations, because that's not easy to do.
It's not. And it's real important for people that are watching that if you're going to go out and raise capital, grow. One, you've got to be able to grow a little bit organically, word of mouth, like we've done. Like I said, we grew over 400% last year. That helps immensely. A couple of things you also need to know is we know, because we've done some testing, what it costs us to acquire a customer. And we know what, because we've been around long enough now, we know what the lifetime value is. So knowing those relationships and those ratios, what's it cost you to get a customer and what is a customer worth over their lifespan really matters. The hard part with SaaS, especially if you're going direct to customer, is scaling is necessary for revenue. Like not just to make money, real revenue to get into an EBITDA positive situation is hard versus an enterprise software company. You need one client, gives you a couple $100,000. Okay, you now got funding to go find one more client.
Also, just a yes and off of that, if you're doing the enterprise B2B thing, if your product is not ready yet, you have services, you have solutions you can do off the back of the safety zone to figure out the product. It's much harder to go direct to consumer.
Much harder. And we're a combination. We're B2C directly, for sure. We've got the majority of our clients are in that world, but we have a handful of B2B2C relationships as well. The end user's using it, but you can call them referral partners. You could call them affiliates if you were paying them. There's other models where you get more people to talk about you, refer you, that have relationships that you can leverage. That's B2B2C. For example, we work very closely with a company called the IRA Club. The IRA Club is a self-directed custodian for people that has their Roth, their 401ks that have rolled over, any of those types of vehicles that they are using to invest. We've integrated directly with them. So now their new customers all get a flip account, and then we can market to them, help them. But it's symbiotic. Them having us helps them a lot. They help us a ton. Together, we're better able to serve those clients.
Yeah, those relationships are amazing. And you mentioned Betterment earlier, and I'm just doing my little Gartner map in my head and trying to figure out where you fit. And I could see how certain investment groups, this is going to be really amazing for them because they don't have an alternative to make it easy for their clients to have a solution that's like Betterment, where you're like, I want the computer to handle it. I also want it to not take extreme risks. And it sounds like you're providing that for specific funds.
Like I said, and I say this, I'm a broken record on it. Probably drives people nuts. We set out to be better in terms of performance and risk. We set out to be a fraction of the cost. We only charge $7 a month. And we wanted to be ridiculously easy. And so we wanted to provide technology to the masses that's not available today. It's not even available to advisors today. We wanted to provide the level of technology that the giant institutions like Deutsche Bank or Morgan Stanley have for their own money. Because I guarantee you BlackRock and Morgan Stanley aren't investing their own institutional dollars in the products they're making available for the public to invest in or for advisors to sell to the public.
Yeah, that's where I guess those independent financial advisor fits into the mix, because at least they're not like consulting that buy their own products.
Correct. But they're still limited to the products available. They can't take their clients' money and go down to the $100 million hedge fund and say, can I take my $200,000 customers' money and put it in the hedge fund? They can't do that. They won't take them. So that's not how the ultra high net worth world works.
This is amazing. This is a cool product that you built. And I'm wondering, like, what are the challenges you're facing right now in terms of marketing? You've already got word of mouth working extremely well. Kind of what's holding you back from the next level right now?
It really is. We can grow our way out of it at this pace. I don't want to. We are, like I said, we are halfway through our Series A. So we've raised 5 of the 10 million. It's a $10 million round. We've raised half of it. And this second half is earmarked almost exclusively for marketing. It's a matter of turning on the faucet because, as we mentioned earlier, running a SaaS company that's B2C is really hard. And it's expensive. We have 17 employees. And so I can't divert funds out of our bank to go market at the risk of not making payroll in 5 months. You have to keep a certain amount of money in the bank. Otherwise, if you don't pay your people, no matter how much they love you, they won't stay. And that's the balancing act. It's finding the budget to spend on the marketing side. People will say, you know how much your customer costs, just take as much as you can. We do that.
Yeah, it's a cash flow game. When you're doing paid marketing and your payback period is not less than 30 days, that's an amazing case. But if it's longer than 30 days, you're like buying these customers. I think of them like an investment, and they're not all the same worth, obviously, but you're investing in customers and you have to balance cash. You can't, and there's a limit. At some point you can't buy anymore and you have to wait till those basically accrue.
That's exactly right. So say a customer's worth $84 a year. How much are you going to spend? Even if they're going to stay 10 years, you would think a 2-to-1 on that would be great. So if they're going to generate, I don't know, let's say $300 total, and you spend $150 to get them, that's a 2-to-1. you're making double your money, but it takes you 2 years to get it. So it's how to navigating that path.
That's the paid marketing thing. And it's funny because when you're running it, I don't know, when I'm running these kinds of things, I'm always thinking like, oh, this payback period, what do I do with this? But if you were not managing it as a SaaS person and you were just looking at it as an investment, it's ridiculous. If there's another area where you can get a 200% return in 2 years, you would take it all day, every day, but you still have to have the cash.
Well, and the fact is that you need a bunch of them. You need a lot of them. So the whole idea, you look at something like Robinhood, historically, how COVID couldn't have been better for those guys, man. Right place, right time, word of mouth, not a ton of marketing, just something for people to do while they were bored at home. And they exploded. Sometimes the perfect storm comes. For them, it did. Now we're trying to create our perfect storm and do it as quickly as we possibly can.
No shade on Robinhood because it's an amazing company. But when I think about, they were a little bit, just from me watching from the outside and not in the industry really, but I saw pushing more risky stuff to beginners, and appreciate that you are not doing that.
No, they were an inspiration for us when we were starting. We loved the idea of simple and easy, but our opinion, no shame, our opinion was that Robinhood did not do enough to help the customer. In fact, they were encouraging behavior, which traditional advisors do the exact same thing. They encourage behavior that puts money in their pocket.
Yeah. And maybe you shouldn't be options trading if your account is small.
Yeah. Nor should you be putting all your money into, again, day trading from your phone as a novice, fine for a hobby. But when you're being encouraged to do these things, and to me, that just doesn't work. That's why you'll notice all the symbols on our platform are all large market cap. There's no OTCs. There's no day trading on our platform. We're not a trading platform. We are an investment platform. You put it in, you pick your smart folio, and you leave it alone. If you do anything, you add to it over time. We're not going to get you 7% a month. Like I literally just got an advertisement on Facebook, some guy promising 7% a month return. Not real. The FCC is going to be talking to that guy.
Yeah. Oh man, compliant marketing, that's a whole other topic. Randy, I think you're making something really cool. I really do. And I appreciate our time together. And I'm wondering, like, what advice would you give to other technology founders, tech founders, to get this kind of word of mouth?
Well, don't put it out till it's at least viable. It's got to be usable. Take your time in that department. Now, I also subscribe to the fail fast mentality. But once you know what it is you want it to do, whatever your widget is, get it out as quickly as you can and get people's feedback and listen to the people in the beginning. We're on iteration 20 now. We have a completely different interface than we did when we started because we were able to put it out, give it to a few, test it out, tell me what you think, and listen to your customers. Listen to them and make those adjustments because they notice and then they stay. Oh, their work is getting better. I love the idea. And so that's the biggest piece to go. Don't go dump a bunch of money in marketing right out of the gate without a proven model. That's my number one advice on it because it's so easy. Yes, everybody's got a beautiful pro forma. That fourth year is completely irrelevant. What's happening in the next 6 months? That's what you need to focus on because I can make beautiful spreadsheets. They look great. But at the end of the day, what are they worth? Nothing. It's about what's going on in the next 6 months. And then lastly, surround yourself with the right humans. The people need to be interested in your cause, not just there for a paycheck. I ask every single person I interview or talk to or before I bring them on the team, is it possible for you to love this job enough that you do it for 2/3 of what you could get somewhere else? And that starts to determine how important the culture is to that person. If they're just there for the job, just there to get the paycheck, I know no harm to them. But early on, those are very difficult people to try and rely on because they're going to clock out at 5, they're going to clock in at 8, they're going to do it.
You can't build a winning startup with that.
You can't build a winning startup with that. It's just too brutal. And lastly, those that do join you, acknowledge them as much as you can. Tell them great job. Tell them you appreciate it. Tell them thank you. Even if you don't have money to buy them stuff or can't pay them a full amount, at least let them know you care. It's easy to get tied up in the day-to-day.
Thank you so much, Randy. I really appreciate it.